Fox Business Alert spin-offs. This is when a company chops off a division and turns it into a separate company. They're typically catnip for investors, but medical device maker Medtronic stock is falling right now by about 2.5%. It's really getting dragged down by the broader market sell-off. This despite announcing it will spin off its diabetes business into a standalone, publicly traded company. Medtronic beat on its top and bottom fiscal fourth quarter earnings lines and raised its dividend by 1.25% to 71 cents a share. So that's good news. But let's get more of the story from Medtronic Chairman and CEO Geoff Martha. Geoff, your diabetes sector actually generated something like $2.8 billion in sales for fiscal 2025. That's a pretty significant, almost 11% increase. Why are you spinning it off right now?
Well, first of all, thanks, Liz, for having me on. The diabetes business is rocking right now. We got our latest technology into the market. It's had 6 quarters in a row of double-digit growth. This last quarter, 12%. We see that going off into the future. And more importantly, it's having a real impact on patients. Remember, our diabetes business is focused around type 1 diabetics. They're insulin dependent, have a problem with their pancreas producing insulin. Things like GLP-1s don't really help, unfortunately. So it's really our therapy is the gold standard, and the incidence of diabetes continues to rise. So we're a very important player in the diabetes space. And the reason for the divestiture really is that as excited as we are where it is in the outlook, the business is more of a B2C company competing against standalone other B2C diabetes companies. And it needs quite a bit of focus and investment that is a bit different from the rest of Medtronic. And we want this business to continue to be the leading franchise in the space. So that's more focus, more investment. And that's the reason for the spin. And then it also, the other side of the equation here, it's a win-win for Medtronic. We have more growth drivers than we've ever had in the history of the company in terms of these are high margin, high growth areas like atrial fibrillation, hypertension, surgical robotics. Those also need a lot of investment. And they're a different market, sold mainly to hospitals and a higher margin profile. So it allows both companies to focus on really their core. And we believe it's going to create shareholder value short and long term.
Okay, well, let's talk short term tariff bruising. Let's put it that way. The tariff damage, you guys reported lower full year guidance because you're expecting a tariff hit of something like $200 million to $350 million this year. Can you tell us specifically what is leading you to make that assessment? Is it input costs, materials for your medical devices that you need to make?
It's a bit of that, right? But the bigger issue is exports. Look, MedTech and Medtronic is a unique American industry. 60% of our global revenue for Medtronic is tied to U.S. manufactured products, and it's a little higher than for the industry as well. Most of the R&D is here. 80% of our IP is held in the United States. We're a net exporter of innovation around the world. And so our big tariff impact is the reciprocal tariffs that are coming back at us as we export out. That's the lion's share of the impact.
Okay. All right. Well, so can you see beyond that? And it's very hard. I understand that because we know that the tariffs with China, those expire August 10th. Before then, the other ones on different countries expired in July. So that's got to be a difficult assessment to be making. It's almost like a moving target. How are you and your team doing that?
Well, we're planning for either scenario, and that was implicit in our guidance. So first of all, we started with an exposure of like $800 million a year from tariffs. We were able to work that down through humanitarian exemptions that exist in our industry, as well as changing some of our shipping routes to be more optimized in this new world. And so we put out guidance, and our plans are for 2 scenarios. One, the scenario stays where it is today, and that's about a 200 basis point impact for EPS next year. And if China tariffs come back, in particular, all the way to where they were, prior to the pause, that's where we get up to more like a $300 million plus impact. So we gave our investors, the worst case scenario in our minds, and we're operating the company around both.
Okay. Okay.
So there's upside. There's upside if the pause continues, or the
Yeah.
pause becomes permanent. If the pause becomes permanent.
Well, okay. We're hearing different things, certainly, depending on the company and depending on which side of the ocean people are on. The U.S. dollar. Now, the dollar had been earlier this year and maybe closer to the end of last year very strong. Now it has turned weak. Does that turn into a tailwind for you?
It does. It does turn into a tailwind. As you know, again, and we're a global company. We sell a lot of product, make a lot of our profit outside the U.S. And when we translate that profit into U.S. dollars, the weaker dollar helps. And it's been at an all-time high till recently, and that's been a headwind for us. As the dollar weakens, it becomes a tailwind for us. That it takes a little bit of time for that to impact us because of our hedging program. But a weaker dollar for us, for Medtronic, is good news, and that'll start to become a tailwind towards the end of this fiscal year.
We like tailwinds. I'm sure you do too. Headwinds, not so much. We've got a few of them with the markets. The Dow right now is down 825. The S&P, the NASDAQ, very close to session lows. But Geoffrey, thank you for coming on to talk about Medtronic. We appreciate it.
Thank you, Liz. Good to see you.